Imagine walking into a glass tower in Houston in the year 2000. The elevators are full of young traders, consultants, accountants, lawyers, executives, and analysts who believe they are working inside the future. The company does not feel like an old pipeline business. It feels like a financial laboratory. There are screens, contracts, models, forecasts, and a language that makes ordinary energy sound like technology. Electricity becomes a market. Natural gas becomes a derivative. Bandwidth becomes the next frontier. Weather becomes something that can be traded. The company is not just selling power. It is selling the idea that anything uncertain can be turned into a price, and once something has a price, it can be turned into a story. That is the first hidden lesson of Enron. In modern finance, a business is not only valued for what it produces today, but for what investors believe it may control tomorrow. This is not automatically wrong. Every serious investment involves the future. A railroad is built before all the passengers arrive. A factory is financed before all the products are sold. A technology platform may be valued for future network effects long before its mature profits appear. But Enron pushed this logic into dangerous territory. It learned that if the future could be modeled aggressively enough, and if the market wanted to believe strongly enough, then tomorrow's imagined profits could be pulled into today's financial statements and used as proof that the story was already working. The mathematics sounds clean at first. If a company signs a long-term contract, it can estimate the future cash flows of that contract, discount those cash flows back to today, and record an economic value. In theory, this is simply present value thinking. A dollar received 10 years from now is not worth the same as a dollar received today. So finance adjusts the future by using a discount rate. But the emotional danger hides inside the estimates. What growth rate do you assume? What future price do you choose? What cost do you ignore? What probability do you assign to failure? Change the assumptions slightly, and a contract that is merely uncertain can begin to look enormously profitable. Enron used mark-to-market accounting in its energy trading business, which allowed unrealized gains and losses from contracts to be reflected in current income. And the challenge was that long-term energy contracts often lacked clear quoted market prices, leaving valuation models dependent on assumptions. The Journal of Accountancy later explained that Enron used this approach on an unprecedented scale, and that unrealized trading gains made up slightly more than half of Enron's reported pre-tax profit in 2000 and about one-third in 1999. This is where the story becomes psychologically fascinating, because the numbers did not just describe the company. The numbers helped create the company's reputation, and that reputation then helped the company keep producing more numbers. The loop worked like this. Enron reported strong earnings, so investors trusted the stock. A high stock price made Enron look safer, more innovative, and more powerful. That reputation helped the company borrow, trade, recruit talent, and make bigger deals. Bigger deals produced more opportunities to estimate future profit. Those estimated profits supported more earnings. More earnings supported more confidence. Confidence supported the stock. The stock supported the company. It looked like a machine that turned intelligence into money, but it was increasingly becoming a machine that turned belief into collateral. Enron did have real businesses. It was not an empty room with a logo. It had pipelines, trading desks, energy contracts, international projects, and thousands of employees doing real work. That is part of what made the illusion so powerful. The fraud did not float in complete emptiness. It attached itself to a real company, then wrapped that company in layers of complexity until outsiders could no longer tell which profits were solid, which were speculative, and which were being manufactured by accounting structures. The phrase, "sold nothing," is not literally true, but it captures the deeper point. The most valuable product Enron sold to the market was not gas, electricity, or bandwidth. It was confidence. Confidence is one of the most valuable assets in capitalism, but it is also one of the most fragile. When a bank trusts a company, credit becomes cheaper. When analysts trust a company, recommendations become easier. When employees trust a company, they accept stock as a symbol of their future. When investors trust a company, valuation rises. But confidence has a strange property. It can hide weakness for a long time, then disappear very quickly. As long as people believe the bridge is strong, everyone crosses it. Once enough, people suspect that the bridge may be hollow. The entire structure is tested at once. The story begins decades earlier, in the less glamorous world of natural gas pipelines. Enron was created in the mid-1980s from the merger of Houston Natural Gas and Internorth, and for a while it looked like an energy infrastructure company. Pipelines are understandable. They are physical assets. They move molecules from one place to another. Their economics depend on regulation, contracts, volume, maintenance, and financing. But deregulation changed the environment. Energy could increasingly be traded in more flexible ways, and a company that understood both physical supply and financial contracts could position itself between producers and customers, turning uncertainty into fees. Jeffrey Skilling understood this opportunity. He saw that Enron did not have to think like a pipeline company. It could think like a market maker. Instead of simply owning assets, it could create markets around those assets. It could stand between buyers and sellers, structure deals, manage price risk, and present itself as the intelligent center of a chaotic energy world. This was not foolish by itself. Many valuable financial businesses exist because they help other people transfer risk. But risk transfer requires discipline, transparency, and trust. Without those, the system that manages risk can become the system that hides it. The psychological shift inside Enron was subtle but enormous. The company began to reward deal-making intensity, numerical creativity, and the appearance of constant growth. In that environment, a completed deal was not just a transaction, it was proof of intelligence. A rising stock price was not just market feedback, it was proof of destiny. Employees were encouraged to see themselves as smarter than old energy companies, faster than regulators, and more creative than traditional accountants. That kind of identity can be intoxicating. When a company believes it is reinventing the rules, it may slowly stop respecting the rules that exist for a reason. This is one of the most dangerous psychological traps in finance. Confusing opacity with genius. A simple company can be analyzed with simple questions. What does it sell? Who pays? What are the costs? How much cash remains? How much debt exists? A complex company requires more patience, but the basic questions should not disappear. Enron made those questions difficult. Its earnings were hard to trace. Its disclosures were hard to interpret. When analysts questioned the details, the company could respond with prestige, vocabulary, and the implied accusation that the skeptic simply did not understand the future. Behind the public story, another machine was operating. Enron used special purpose entities, often called SPEs, to finance assets, move risks, and in many cases, keep debt or losses away from the company's visible balance sheet. Special purpose entities are not automatically fraudulent. They can have legitimate uses in finance, but Enron's use of them became a central part of the illusion. The SEC later alleged that Andrew Fasto's formation and use of Chuco helped Enron conceal millions in debt while falsely increasing income, and that certain entities should have been consolidated into Enron's financial statements. The problem was not merely complexity. The problem was complexity arranged in a way that made the company look stronger than it was. The math of this is easier to understand than the legal documents suggest. Suppose a company owns an asset that is falling in value. If the company keeps the asset, it may have to recognize a loss. But if the company can sell the asset to another entity, it may avoid showing the loss immediately or even record a gain. Now suppose that the other entity is supposedly independent, but is actually supported by the company's own stock, guarantees, or hidden commitments. In economic substance, the risk has not truly left the company. It has just moved into a darker corner of the same house. The balance sheet looks cleaner, but the building is not safer. This kind of structure creates a financial illusion, similar to moving clutter from the living room into a closet before guests arrive. The room looks clean, but the clutter still exists. If the closet is small and the clutter is large, eventually the door will not close. In Enron's case, the closet was built from partnerships, related party transactions, aggressive valuations, and confidence in the company's own stock price. As long as the stock remained high, some structures could appear stable, but when the stock began to fall, the supports weakened, and the same mechanisms that had hidden fragility began to reveal it. This is the mathematics of reflexivity. A company's stock price is supposed to reflect business reality, but sometimes the stock price also helps create business reality. If lenders accept stock as support, if counterparties trust the company because of market capitalization, if employees stay because their stock compensation looks valuable, and if accounting structures rely on equity value, then a falling stock price does not merely signal danger, it produces danger. The symbol becomes part of the machinery. Once the symbol cracks, the machine begins to fail. Enron's fall was therefore not a single dramatic moment. It was a loss of belief that accelerated into a liquidity crisis. Questions accumulated. Short sellers, journalists, skeptical analysts, and internal voices began pressing on the gap between reported success and understandable cash generation. Creditors became nervous. Trading partners became cautious. The stock price fell. The falling stock price weakened structures connected to that stock. Weakening structures raised more questions. More questions caused more selling. More selling caused more fear. The company that had used confidence as fuel discovered that confidence can also behave like oxygen leaving a room. The human cost is easy to lose inside the accounting language, but it is the reason the story still matters. Enron's collapse affected employees, shareholders, pension funds, creditors, and the public's trust in corporate reporting. Congressional oversight accounts describe Enron's employees losing jobs and retirement savings, while stockholders saw investments nearly wiped out as the stock fell from about $90 in 2000 to cents by the end of November 2001. The FBI described the collapse as leading to what became the most complex white-collar crime investigation in its history, with officials accused of cheating investors through accounting gimmicks that overvalued assets and boosted reported cash flow and earnings. The deeper business logic Enron exploited was the gap between narrative value and cash value. Narrative value asks what the market is willing to imagine. Cash value asks what the company can actually produce, collect, and keep. Great companies often begin with narrative value because the future must be imagined before it can be built. But over time, the narrative has to meet cash. Customers must pay. Costs must be controlled. Debt must be serviced. Promises must convert into durable economics. When the narrative expands faster than the cash reality, valuation becomes a bridge over a canyon. It may hold for a while, but the distance underneath keeps growing. This is why the Enron lesson applies to many eras, not just the early 2000s. Whenever markets become excited about a new frontier, they become more tolerant of missing cash flow, unclear business models, and complicated metrics. Sometimes that tolerance is justified because innovation is messy at the beginning, but sometimes complexity becomes a shield. The same words appear again and again: platform, ecosystem, marketplace, transformation, disruption, proprietary model, strategic optionality. These words are not bad by themselves. They become dangerous when they replace the basic discipline of asking how money actually moves. To understand Enron, follow the money rather than the language. Who pays whom? When is cash received? What assumptions turn a future contract into present profit? Which debts remain visible and which are moved elsewhere? What happens if the stock falls? What happens if counterparties demand collateral? What happens if growth slows? These questions are not glamorous, but they are the questions that separate a business from a performance. Enron's public image was futuristic, but its failure was ancient. It depended on leverage, opacity, conflicts of interest, and the human desire to believe that a rising price confirms a true story. One of the most important concepts here is incentive drift. At the beginning, incentives may reward useful innovation. A company finds a better way to trade energy, manage contracts, or allocate risk. But as the market begins rewarding reported earnings and stock performance, the internal culture can shift. People are no longer only paid to build durable value. They are paid to produce the appearance of durable value on a quarterly schedule. Once that happens, accounting becomes not merely a measurement tool, but a strategic weapon. The question becomes not what happened, but what can we recognize? And eventually, what can we get away with recognizing? The aftermath changed American business because it damaged trust in the mechanisms that were supposed to protect investors. Enron's collapse contributed to the creation of the Sarbanes-Oxley Act, which strengthened requirements around corporate financial reporting, executive responsibility, and document preservation. Britannica summarizes the scandal as a series of dubious accounting practices that led to Enron's 2001 bankruptcy and the dissolution of Arthur Andersen, one of the largest auditing firms of its time. The legal reforms mattered, but the psychological reform is just as important. Investors had to relearn that prestige is not evidence, complexity is not safety, and innovation is not the same thing as integrity. So the practical question is not, could I have spotted Enron perfectly? Most people could not. Even many professionals failed to understand the full picture. The better question is, what pattern should make me slow down? When reported profit repeatedly outruns understandable cash flow, slow down. When the business model depends on valuations that only insiders can explain, slow down. When debt disappears into structures that require footnotes longer than the explanation of the core business, slow down. When criticism is answered with arrogance rather than clarity, slow down. When everyone says the company is too innovative to analyze with old rules, slow down. The identity shift is from spectator to analyst. A spectator asks whether the stock is going up. An analyst asks what reality must be true for the price to make sense. A spectator borrows confidence from the crowd. An analyst studies the mechanism behind the confidence. A spectator sees complexity and feels impressed. An analyst sees complexity and asks whether it explains value or hides risk. This does not make the analyst cynical. It makes the analyst patient. The goal is not to reject every ambitious company. The goal is to separate ambition from accounting fog. Enron's story is shocking because it shows that a company can become enormous partly by teaching the market how to misunderstand it. It converted future possibilities into present earnings, confidence into credit, stock price into structural support, and complexity into a kind of social armor. For a while, the system worked because everyone around it benefited from believing it worked. Employees felt wealthy. Executives looked brilliant. Banks earned fees. Analysts had a growth story. Investors had a rising chart. The machine did not need everyone to be dishonest. It only needed enough people to prefer the story over the harder questions. And then, when the questions finally became unavoidable, the same machine ran in reverse. The stock price that once created confidence began creating fear. The structures that once hid risk began revealing obligations. The reputation that once attracted capital began repelling it. The future profits that once looked like wealth began looking like guesses. The glass tower did not collapse because energy stopped mattering. It collapsed because the numbers had become detached from the economic reality they were supposed to represent. That is the final lesson. Money is not just math, and it is not just psychology. It is the place where math and psychology meet. The math gives a price to the future. The psychology decides whether people trust that price. When both are disciplined, finance can allocate capital, manage risk, and support real growth. When both become corrupted, finance can create a beautiful illusion with a balance sheet attached. Enron was not merely a company that failed. It was a warning about what happens when a market stops asking whether the story can survive contact with cash. So when you hear about the next company that seems too complex to question, the next valuation that seems to float above ordinary business logic, or the next financial innovation that promises to turn uncertainty into effortless growth, remember the tower in Houston. Remember that the most impressive number in a market is not always revenue, assets, or market capitalization. Sometimes the most important number is the amount of real cash that remains after the story is stripped away. Because in the end, every financial narrative has to face the same quiet test. Not how confidently it can be told, but whether it can still stand when belief is no longer enough.